Hey everyone, welcome back to Corporate Decoder. Today, Quest Diagnostics Incorporated, ticker DGX, just dropped its quarterly report, and I'm seeing a significant shift in their financial health, especially in how they're managing their debt. Quick note, this is not financial advice. Just my take on public filings for educational purposes. The company is showing solid revenue growth, but a closer look at their balance sheet reveals some interesting moves that could impact them down the road. Let's dive into what Quest Diagnostics is telling us in this latest report for the quarter ending the 30th of June 2026. Looking at their income statement, Quest Diagnostics reported a good jump in net revenues. For the 3 months ending June 2026, total net revenues were about $3 billion, up from $2.7 billion in the same period last year. That is a pretty healthy 10.2% increase. For the first 6 months of the year, revenues hit nearly $6 billion, up from about $5.4 billion, a nearly 10% rise. This growth seems to be driven mainly by their Diagnostic Information Services, or DIS business, which is the backbone of their operations, making up almost 98% of their total revenue. Specifically, their DIS business saw revenues climb to nearly $3 billion for the quarter, a rise of over 10%. This strong performance is attributed to a significant increase in test volume, up by 13.1%. This surge in volume is partly due to new partnerships like their collaboration with Corewell Health and increased testing for Fresenius Medical Care. While volumes are up, the revenue per test actually slightly decreased by 2.8%. This is mainly because the new partnerships involve more routine, lower price tests, which is a common trade-off when you expand into new service areas. Now, let's talk costs, their cost of services, which includes everything from collecting and transporting specimens to running the tests. Went up considerably. For the quarter, it rose by about 11% to just over $2 billion. This increase is mainly due to higher employee pay and more spending on supplies, which makes sense given the higher testing volumes. However, they are also seeing some savings from their Invigorate program, which is designed to make their operations more efficient and cut costs. Selling, general, and administrative expenses, or SG&A, also saw an increase. For the quarter, it was up 9% to about $529 million. This is mostly due to higher compensation costs. Despite these rising costs, Quest Diagnostics managed to increase their operating income. For the quarter, it went up by about 4.6% to $459 million. This means they are still growing their profits from their core operations, even with increased expenses. And for the bottom line, net income attributable to Quest Diagnostics for the quarter was $320 million, a nice jump from $282 million in the same period last year. This translates to diluted earnings per S-share of $2.84, up from $2.47. So financially on the surface, things look pretty good for Quest Diagnostics. But where things get really interesting is when we look at their balance sheet here. We see a clearer picture of their financial structure. Total assets grew to almost $17 billion by the end of June 2026. This growth is driven by increases in goodwill, which represents the value of acquired businesses and intangible assets. On the liabilities side, their accounts payable and accrued expenses remained relatively stable, around $1.6 billion. Now, let's talk about debt. This is where I see some significant shifts. Their long-term debt stands at over $5.6 billion. What is notable is how this debt picture has changed. Back in December 2025, their current portion of long-term debt was quite high at over $500 million. But by June 2026, it had dropped dramatically to just $10 million. This means they paid down a substantial amount of their short-term debt obligations. This is largely because they repaid their 3.45% senior notes that were due in June 2026. At the same time, they issued new 5.00% senior notes due in 2036, raising $500 million. This strategic move reduced their near-term debt burden, but also increased their long-term debt and the interest rate on that portion of their debt. Looking at their debt maturities, they have a significant amount of debt coming due in the next few years. For example, in 2027, nearly $410 million is due, and in 2029, over $1.1 billion will mature. While they've reduced their immediate debt pressure, managing these upcoming maturities will be key. Quest Diagnostics also uses financial instruments called interest rate swaps to manage their risk. These swaps help them convert their variable interest rate debt into fixed interest rate debt. They have a substantial amount of these swaps with a notional value of $1.8 billion. As of June 2026, the net fair value of these swaps was a liability of $21 million. This means that if interest rates were to change significantly, this could impact their financial results. Another interesting item on their balance sheet is contingent consideration, which is basically money they might have to pay in the future based on certain performance conditions from past acquisitions. As of June 2026, this liability was $100 million. This relates to their acquisition of Haystack Oncology, Inc., and depends on them achieving certain revenue benchmarks or getting reimbursement coverage from Medicare. It highlights the ongoing financial commitments tied to their past growth strategies. They also report a redeemable non-controlling interest of $80 million. This is related to a joint venture with UMass Memorial Medical Center. The key here is that this interest can be redeemed, meaning Quest Diagnostics might have to buy it out at fair value, which adds another layer of financial uncertainty. The company's business is primarily divided into two main areas: Diagnostic Information Services, or DIS, and Diagnostic Solutions, or DS as we saw. DIS is the dominant force, accounting for over 95% of revenues. The DS segment, which includes risk assessment and healthcare services, is much smaller but still contributes to their overall business. Quest Diagnostics is also continuing its Invigorate program, aimed at driving cost savings and improving productivity. They incurred about $9 million in pre-tax charges for this program in the first 6 months of 2026, mostly for employee separation costs. This shows they are actively working to streamline operations and manage costs as they grow. In the notes section, there are several legal matters mentioned. These include ongoing investigations related to billing practices and past data security incidents. While the company states that they do not believe the outcome of these matters will have a material adverse effect, it is always something to keep an eye on, especially with potential fines or settlements. Looking at leadership actions, some executives have adopted new trading plans. For example, Mark Delaney, the SVP and Chief Commercial Officer, adopted a plan to sell up to 1,600 shares of common stock. This is a pretty standard move for executives who want to diversify their holdings in a planned way, especially as stock options vest. Quest Diagnostics is showing impressive revenue growth, driven by increased test volumes and strategic partnerships. Their DIS business is performing strongly, and they are actively managing costs through their Invigorate program. The significant reduction in short-term debt is a positive sign, demonstrating a commitment to financial health. However, the increase in long-term debt, coupled with ongoing debt maturities and the use of interest rate swaps, indicates a more complex financial strategy. The contingent liabilities related to past acquisitions and joint ventures also add a layer of uncertainty. My biggest concern is how they will manage their substantial long-term debt obligations in the coming years, particularly as interest rates fluctuate. While they have a robust credit facility, proactive debt management will be crucial. I'll be watching to see if their Invigorate program can continue to deliver cost savings to offset rising operational expenses and manage the impact of lower revenue per test from new business lines. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.